Hello, you're watching Be the Boss of Your Money. We're live now. Thank you so much for joining me. I'm Mitch Goldberg. You're watching my live stream. It's called Be the Boss of Your Money because I want you to be the boss of your money. Ooh, that's a mouthful. I don't want your money to be the boss of you. So let's just roll with it for a little bit today. Here is our thumbnail, and we are going to get started. Today we're talking about, count them, two stocks that I think are on their way to paying a dividend. These are well-known companies, well-established, the kind of companies that I think money managers, professionals like to buy and put away in their exchange-traded funds and their mutual funds. So we've got two important stocks to talk about. We've got a quick update, and then I want to talk to you a little bit about personal finance and why you should know what an ACH is, automated clearinghouse, and how that can actually help you accelerate your savings so that you could meet your financial goals. So let's roll the quick intro, and then we're going to just get right into this. Good stuff today. Hello there. This is Mitch Goldberg. Welcome to my live stream. It's called Be the Boss of Your Money. It's about personal finance, investing, how you could further achieve your financial goals. So we talk about planning. We talk about a lot of obviously financially related topics. Sometimes we bring other topics in here as well. But focusing today on money, on the stock market, on why it's important to save first, then spend, as opposed to spend first and save later. So let's get into today's action. The stock market last week had a really solid, real solid rebound from the week before. The week before last week was the GameStop week when short sellers were forced to cover their positions by buying stocks like GameStop, sending these stocks into the stratosphere. Crazy runs that these stocks had, just presumably because of retail traders who use Reddit, the Reddit community, Wall Street Bets, to say, we're going to take down these hedge funds. And what I've said then, I want to repeat. What a shame to finally for investors to finally take a stand on GameStop. I mean, there are so many good companies to buy, but maybe you've decided GameStop is where you want to make your mark. Were you buying GameStop because you really thought the company is worth owning? Because it's not, in my opinion. It's the company, it was questionable as a going concern before all this happened, which is why professionals were shorting it, because they did their homework. They looked at what the company is worth, and they determined that there's really not that there's really not a viable company. So they shorted it. So investors feel like they took credit for that, retail investors, but it turns out there were a lot of professional investors buying it alongside you who then got out as well. And then you had all the trading restrictions with Robinhood, Interactive Brokers, Z-Trade, all the online firms put trading restrictions on the stock, mostly to protect their own capital. They say it was to protect investors, but I think it was more to protect their own capital. So having said that, last week, these stocks, BlackBerry, KOSS, AMC, stocks plunged. And I feel like this week we're not even talking about it anymore, which is a good thing. But it bears repeating because it's Monday, so I'm doing a little bit of what did we speak about last week, okay? So it's important to do that little review. I see you out there, Steve. Thank you for joining me. I really appreciate that. You probably think, maybe you could see me? No, I can't see you, but I see who likes the stream, and then I see the name. Okay, so thank you very much, buddy. Last week, the important thing, what we closed the week with last Thursday, was I'm feeling bulled up. I'm feeling really bulled up. There are a lot of good things going on with the economy in terms of manufacturing, service, auto sales, reflation trade, energy sales going up. I mean, I'm finding it very difficult to be negative on the economy. And based on corporate earnings that have been coming out for the last 2 weeks, things are really starting to look good for corporations, for corporate America. The jobs numbers, okay, now this could come off as insensitive, but labor figures are considered a lagging indicator. So labor figures will be the last part of the puzzle that you see improve heading into a stronger economy. It takes a while to hire people. It's a lot faster to fire people than to go through the whole hiring process and hire a lot of people. Plus, companies have cut back and they have learned how to do more with less people. So I don't think they're going to be in a rush to just, start hiring everybody back. They're going to hire very tentatively, very hesitantly. But the economy itself, I'm feeling pretty bulled up because I'm looking at the statistics. I'm looking at the numbers. The numbers don't lie. The stats don't lie. The earnings could lie, but the revenues don't lie. There's a lot of funny things that happen between money going from the top line to the bottom line, but earnings by and large have been phenomenal this season. Over 80% of companies that have reported so far that are members of the S&P 500 have beaten expectations in earnings. By the way, the S&P 500 is an index. You can't invest directly into an index, but you could certainly invest in a security that tracks or mimics an index. Just have to get that in there. So there's a reason why I'm bringing this up, because I'm feeling pretty bulled up because the right stocks are starting to go up, because something called the yield curve has steepened, and the yield curve determines the health of banks, and it is a call on confidence in the economy, and it's a call in confidence in bank stocks and other economically sensitive stocks, as opposed to just the continuous work from home, stay at home stocks, tech stocks, communication stocks. So I'm feeling pretty optimistic about things. The fact that interest rates are going higher, I've said on the show many times, we want to see interest rates go up. We want interest rates to go up because it means that the demand for money is going up. Money is like anything else, supply and demand. And when there's more demand for money, it becomes more expensive. Like if there's more demand for any product, the price goes up. There's more demand for money. What does demand for money look like? Loans. Loans show you demand for money. So that's why rates are starting to creep up. We don't want rates to go up very fast. We want them to creep up little by little. If they creep up too fast, that kind of throws things off, and then we have some market volatility. But at this pace, interest rates are, investors have made their judgment. They're very comfortable with this. So moving on. There are reasons to be bulled up on the economy, and I think investors 2 weeks ago got a little too pessimistic. I guess you could say stocks have gone up too far, but it's not a stock market. It's a market of stocks. And what I'm looking at here are a whole bunch of stocks who are still not up to their former, 2019 or early 2020 peak prices. And they're actually doing quite well. The Federal Reserve came out with all kinds of programs to inject liquidity into the economy, into corporate bonds, into companies, and it's working. It's pretty much, I think, a fair bet that President Biden and the Democrats are going to get their $1.9 trillion stimulus package out. They're going to have a bigger child tax credit in the order of $3,000 to $3,500 annually, which will be paid to families monthly for kids under the age of 6, like $3,500, and then $3,000 from 4 to 17 for single people, individual tax filers for $75,000, joint filers for $150,000 annual income. and it gets phased out up to like 199,000. Okay, for families, for joint filers. These are like these things are so incredibly bullish for the economy. It's just wild. The sad thing is, over the summer, when the HEROES Act was introduced, that was $3.1 trillion, but interest rates were about half of where they are now. Right now, the 10 years is about 1.1, almost 1.2%. And the 10-year yield at the, over the summer was like 0.5, 0.4. So we could have done all this months ago with a really big package, and it would have cost a lot less money. Probably the $1.9 trillion would have cost the same as about $3 trillion 6 months ago, 7 months ago. That's what happens when you hesitate. When the iron is hot, when interest rates are like at 0.5% in the 10-year treasury, the global demand for treasury securities is so immense. Sell as many bonds into that as possible. Hit that bid, lock in low rates for 10 years, 30 years on the 30-year bond, and just raise all that money. You don't have to spend it all. Well, we know it'll all get spent, but that was a really good time to do it. Now is a good time also, right? So the best time was last summer. The second best time is now. But with that stimulus package, I'm feeling more bulled up on the economy. Much more so than I was, and I was pretty bullish on the economy 6 months ago. But all of the things that you see coming out with earnings and corporations' forecast for the coming quarters, why wouldn't you be, bulled up? So let's take a quick look, and I want to talk to you about two stocks that I think are on their way to a dividend increase. They have something to do with transportation, both of them, one more than the other. So it's a little juxtaposition, a little play in words when I say on their way to possibly raising a dividend. So let's do a quick share screen. All right, you see that? Let me put my handsome mug in there. Okay, all right, here I am. See me up in the upper left-hand corner? Maybe I'll go upper right-hand corner. All right, that's better. Okay, so let's take a look. You see this here? The Dow up 237 points, continuing its rise last week. New record high hit today in the Dow Jones. Record highs all around. The S&P 500 is almost 4,000 already. I mean, I remember hitting 3,000. It was like, wow, we're almost up to 4,000 already. So the major averages were up solidly. The Nasdaq up almost 1%. Gold was up a little over 1%. Energy continues its run. I remember that stock rounded 40, then 50. It's almost 60. And people are still bearish on energy stocks. If you recall, a few months ago, we spoke here right here on this channel, on this live stream. Energy stocks and bank stocks are the two value plays for me that I consider real value plays with upside catalysts right now, not just a value stock that'll stay value forever. That's a value trap. I'm talking value stocks with a clear catalyst right now. The banks, rising yield curve, energy stocks, rising oil, happening right now. Not too late. You didn't miss it. All right. So the VIX can, up a little bit, but at 21. That spiked to the high 30s recently. All right. Transportation's had an okay day. Utilities are off a little bit. Copper continues to climb up. Let's take a look at the 10-year treasury, 1.1. You see that? Right under my name there, 1.17%. The 30-year did touch 2% for a tiny little while today, and that's pretty significant. Okay, let's move on. Reopening stocks. This is one, if you're a client of mine, you know that LUV, Southwest Airlines, right in the middle here, is a recent addition to your accounts in the high 30s, low 40s, mid 40s. It's up over 4% today at $52. Still a good deal below its high. Guys, when these stocks break through their highs, when these break through the highs, technically speaking, that's a very bullish sign. I think they just keep marching right on if they could break their highs. It's a big if. So I have to, condition that if they break their highs. But American, Carnival, Planet Fitness, Norwegian Cruise, Cinemark, it was off a little, Marriott off for a Caribbean off a little, but that's okay. These stocks haven't been doing too badly. Marriott came down pretty hard, recovered pretty quickly. Something like 10% of the U.S. population. I know at least 10% of the population has gotten their first COVID vaccine. I think it's even higher. I'm not sure if that's the first or both vaccines, both first shot and second shot. The Johnson & Johnson vaccine should be out in a couple of weeks. Personally, people talk about, I want the Moderna vaccine. I want the Pfizer. I'll get the Johnson & Johnson vaccine. It's not quite as effective and keep you from coming down with the symptoms of COVID, but it is very effective of you not dying and not too far from the other one. So that's really the important thing. And I don't want to wait too much longer. I want to get that before the mutations spread too quickly. Let's move on. We're flying through this, guys. The work from home stocks were more down than up. They had a big week last week. Sector stocks, energy. See this XLE? These are the major ETFs that represent the 11 major sectors of the economy, according to McGraw-Hill S&P. So energy, financials, technology, industrials, materials, especially when you see industrials, XLI, these are the economically sensitive stocks. So that is a discretionary. XLY was up. That is a very, for at least today, a very strong vote of confidence for the economy. Okay, so let's go back to stop sharing the screen. Now, I want to talk to you about two more things, two stocks that I think are heading toward a dividend. All right. The first one is GM, General Motors. And it's almost like, I feel like you might think that, like if I recommend GM, it's almost like, what a lousy company. Remember, GM was called Government Motors because around 2010, 2011 or so, they were bailed out by the U.S. government. The U.S. government basically took over the company, and then they turned it out again into a new IPO. Company came public again. Same company helped, this maneuver helped them survive right through bankruptcy. Can you imagine this country not having a major manufacturer and employer like General Motors? I mean, the automobile industry globally is such an important sector. So it was necessary to do. Steve Ratner was the one in the Obama administration who handled that incredible job. And so now we have GM. For my entire career of 31 years, GM has been undergoing some form of restructuring. But at this point, they not only have broken through the restructuring, kind of like airline stocks that the auto companies now make money and they're not just speculative trades. You could actually buy these stocks and own them because the companies have gotten better. These are real, solid, legitimate companies. GM is moving from an industrial company toward becoming an ESG company. So that attracts a whole new level, a whole new round of stock buyers who want ESG. And the other thing is GM doesn't pay a dividend. So let's just take a quick look at GM on the screen. Okay. There I am over here. Let's go to GM. All right. GM hit a 52-week high today. All right. Stock closed. It touched $57 a share. And the company had a really good earnings and revenues report, really solid report. And Mary Barra, the CEO of the company, said, we're moving toward mostly, it's tough to decipher. She didn't say she's going only for GM electric cars, battery operated cars, but it's their expectation that they will be heavily or mostly into electric vehicles. And it's going to happen by 2035, which in the scheme of things for a giant like this, that's not a particularly long time to wait. But if you notice, the dividend is zero. This company hasn't paid a dividend in a long time. But when companies pay a dividend, by the way, folks, if you have any questions, ask me in the comments. Okay. Welcome to you in the live stream. Welcome to you if you're watching this in the replay. If you have any questions or comments, if you have any questions, hit me up in the comments. It's okay. Words of wisdom, words of encouragement, and a simple hello are always appreciated. But if you have a question, hit me up in the comments. So back to GM. When companies pay a dividend, it makes the company more attractive to a whole wide swath of investors searching for income. It also makes the stock more attractive to investors because it's such a strong vote of confidence from management of the company, because companies hate lowering their dividend or eliminating their dividend. So if GM initiates a dividend, it's because they're confident that they could maintain it. And then it attracts a certain kind of money managers, certain exchange traded funds, mutual funds that have an objective or a mandate to invest in stocks that pay dividends. Then they come into the stock. So it attracts even more investors. So I think it's a really good time for GM, just because I personally believe. Now, I don't have any inside track on this. I haven't spoken to the CEO, Mary Barra. She hasn't called me up and said, hey, I want to let you know, advanced knowledge, we're paying the dividend. No, nothing like that has happened. It's my feeling that GM is back to being a blue chip. And part of being a blue chip is being in a special club with a decent balance sheet and a decent dividend yield. And I think GM is moving toward paying a dividend as their fortunes improve. The next one I want to talk to you about is Southwest Airlines. These companies were basically bailed out. Once COVID hit, the airline industry was decimated. These stocks tanked. But Southwest has just been such a bull. And I like this one above and beyond other airline stocks because this one focuses more on the American consumer. And since this, the symbol is LUV, Southwest Airlines, because its focus is on the consumer and people get back to leisure travel. I think leisure travel, from everything I've read, from what I understand, it's expected that leisure travel comes back before business travel. And Southwest is really more of a leisure, pack the customers into an airplane kind of company. All right, it's a basically a budget airline that operates very well. So as leisure comes back, you'll start to see Southwest do better and better. And the stock is certainly reflecting that. And now with more people getting vaccines, now with more people getting the COVID vaccine, it tells me that the picture for the airline industry, in particular, Southwest, which focuses almost solely on leisure travelers, is the stock to bet on. The stock tells me that. That's what the stock tells me. So I'm not looking for any inside track here. I'm just telling you my experience of 31 years of doing this. I see some good things here. And then if you take a look, I'll do the quick share screen. Okay. All right, back in the corner. Hey, here I am up in the right-hand corner. If you take a look at Southwest and you look at their dividend yield, the dividend is zero. They cut the dividend because they've gotten so much money. It wasn't right for this company to have all the layoffs and furloughs and keep paying shareholders a dividend. But as travelers come back and companies like Southwest, the airline industry, has cut costs, parked planes in the desert, and they have done everything they can so that it is a lower cost of operating, so that when business does come back, a company like Southwest has huge operating leverage, meaning just a little bit more revenue has a big impact on the bottom line. That to me means that Southwest could have massive earnings upside potential. And because of that, they could reinstate their dividend. I don't know when. 3 months, 6 months, a year, 2 years. It's really tough to say when. I think they want to do it, though, as soon as possible. I think 2 years would be a longer time than I would expect. I think 3 months is shorter of a time than I would expect. But 6 to 9 months, a year, when the vaccines have become widely distributed, people are flying again, they're hiring people again, they're bringing back laid off and furloughed workers, that'll probably be a time when they can get away with instituting a dividend or reinstating a dividend. And then it becomes attractive to a whole new cohort of investors who are searching for income and money managers who have mandates to buy dividend paying stocks. And like GM, we'll add Southwest to this. They pay a dividend, start small, but if it's expected that those dividends will be raised consistently over time, that is the kind of stock that money managers love to buy. And it's proven that companies with fat dividend yields, ETFs of companies with very big dividend yields versus companies that have smaller dividend yields but raise their dividends consistently, the ETFs with stocks that pay smaller dividends but raise them consistently have by far and away outperformed the high yield dividend ETFs. Okay, so that to me is pretty bullish sign for these two stocks. Last thing I want to talk to you about is this. Do you know what an ACH is? Automated Clearing House Network. Most payments today that are bank to bank go through the Automated Clearing House Network. And and you know how you automatically put money into your 401k plan. You get paid every pay period, whether it's every 2 weeks, every month, and then money automatically comes out and goes into your 401k plan. And then you get paid and taxes are taken out, your 401k contribution is taken out, and then you live on what you have left. But what about doing the same thing, automating your savings so that when the money comes in and hits direct deposit into your checking account, have it automated so that the money is sent to a savings account, even to a savings account at the same bank or another bank. You're less likely to touch that money. And this way, you could save before you spend. If you try to save money after you pay all of your expenses, you are going to have X amount of money, hopefully left over. It's very tough to save money that way. But if you save first, 5, 10, 15% of your income, and then, and not including your 401k plan, because you've already done that, presumably in this example, and then you spend what's left over, you'll have a much higher success rate of building up your savings account, an emergency fund, and then going further with a savings account. I don't want to confuse an emergency fund with a savings account. They're two different things. Okay, so this is what I want you to think of. You automate your 401k plan, automate your savings at your bank with an ACH form, an automated clearing house form. ACHs are generally speaking free. Banks, I have yet to see a bank that charges a client to send an ACH from their bank account into their account with me, and vice versa. When I send a check out to the client, I never see there's no charge for that. I've never seen one. Okay, there's no charge for that. Unlike a wire transaction, which can happen within the same day, even within the same hour. It's usually $25, $30 fee to do a wire transaction, sometimes even more. ACH is typically happened by the next day. There's no guarantee that they happen the next day. It could take 2 or 3 days. But in my experience of many of decades of doing this, ACHs, from what I see, always happen the next day. So ACH, automate your savings accounts, your savings, just like you automate your 401k plan. And that would help you go a long way in meeting your savings goals. I want to thank you for watching today. This is Be the Boss of Your Money. If you think of any questions after the live stream, certainly hit me up in the comments below. And I will hopefully see you as soon as possible. All right. Thank you. And I'm going to end this broadcast now.